What would happen if the most important gold transactions today weren't taking place on trading screens at all? As global gold prices surged to record levels above $2,400 per ounce in 2024 and remained elevated into early 2026, reaching as high as $5,500 per ounce, China began implementing a strategy far less visible than price charts suggest. Instead of competing aggressively for gold on international markets, Beijing has quietly expanded its control over gold production, targeting strategic mining assets around the world, most notably in Africa. Over the past decade, Chinese mining groups have steadily increased their presence in countries such as Mali, Ghana, Ethiopia, and the Democratic Republic of Congo, regions that together account for roughly 1/4 of annual global gold production. These are not minor acquisitions. Many of the assets involved include operating mines and late-stage development projects with multi-decade lifespans. At the same time, global gold discoveries have declined sharply since the early 2010s, while average ore grades continue to fall and production costs rise. In this environment, ownership of economically viable deposits is becoming more valuable than access to spot markets. The strategic logic is straightforward. Buying gold on open markets exposes a country to price volatility, liquidity constraints, and potential geopolitical pressure. Controlling gold mines offers a far more powerful advantage: stable long-term supply, resilience against market disruptions, and leverage during periods of financial stress. For a country seeking to diversify away from the US dollar and strengthen monetary resilience, upstream control provides structural benefits that no ETF or bullion reserve can match. Before we examine how this strategy fits into China's broader financial and geopolitical positioning, welcome to GE Economy, a channel dedicated to in-depth analysis of economics, finance, and market dynamics. If you find this perspective valuable, don't forget to like the video and subscribe to the channel to receive more insights like this. If China's broader strategy is about controlling gold at the source, then the proposed acquisition of elite, allied gold represents the moment where that strategy becomes concrete. In late 2024, Jin Mining Group, one of China's leading state-linked mining conglomerates, moved to acquire the Toronto-listed gold producer in a cash deal valued at approximately $4 billion, offering a premium of roughly 5–6% over the company's prior market price. The bid was not merely financial, it was deliberately decisive, signaling a willingness to pay above market value to secure high-quality, long-life assets. Allied Gold is far from a marginal player. As of N2024, the company controlled more than 530 tons of gold resources, with annual production rising from 10.7 tons in 2023 to 11.1 tons in 2024, and projected to reach 11.7, 12.4 tons in 2025. Even more significant is its growth pipeline. Expansion projects underway in Mali and Ethiopia are expected to materially lift output over the medium term, with internal estimates pointing toward potential production of up to 25 tons per year later in the decade. In an industry facing declining discoveries and rising costs, such scalability is increasingly rare. For China, the strategic payoff is clear. The transaction would immediately add both physical gold supply and future production capacity, while deepening Beijing's presence in geopolitically sensitive regions where Western mining investment has slowed. Mali and Ethiopia are not just gold-rich jurisdictions, they sit at the intersection of resource competition, political volatility, and shifting global influence. By securing control over these assets, China is not simply buying gold, it is embedding itself more deeply into the upstream architecture of global supply. In that sense, the Allied Gold deal is less a standalone acquisition than a keystone move in a much larger, long-term strategy. The significance of deals like Allied Gold becomes clearer when placed against the broader shift now reshaping the global financial system. After more than a decade in which gold played a secondary role, the metal has decisively returned to the center of monetary strategy. Persistent inflation following the 2022 stimulus cycle, prolonged geopolitical tensions, and rising concerns over sovereign debt sustainability have collectively altered how risk is priced. By 2024, gold had outperformed most major asset classes, reinforcing its function not as a speculative trade, but as a strategic reserve asset. This shift is most visible in the behavior of central banks. According to data from the World Gold Council, central banks purchased over 1,000 tons of gold annually in both 2022 and 2023, the highest levels on record. The pace remained elevated through 2024, signaling that official sector demand is structural rather than cyclical. China has emerged as one of the most consistent buyers. The People's Bank of China has reported steady monthly additions, lifting official gold reserves to approximately 2,300 tons by late 2024. While gold still represents a relatively modest share of China's total foreign reserves, many analysts believe the true figure may be significantly higher due to off-balance sheet accumulation channels. What distinguishes this cycle from previous gold rallies is intent. Central banks are not buying gold to trade price momentum. They are buying to reduce exposure to dollar-denominated assets, hedge against financial sanctions, and strengthen balance sheet resilience. In this context, gold is no longer merely a hedge, it is once again a pillar of monetary sovereignty. Gold's renewed monetary role also explains why China's accumulation strategy cannot be separated from its broader effort to reduce dependence on the US dollar. Over the past decade, Beijing has gradually restructured the composition of its foreign reserves, pairing steady gold accumulation with a visible reduction in U.S. Treasury holdings. According to data from the U.S. Treasury Department, China's holdings of U.S. government debt declined from a peak of roughly $1.32 trillion in 2013 to around $780 billion by late 2024, marking a reduction of more than 40%. This shift has unfolded quietly, but consistently. The motivation is increasingly geopolitical rather than purely financial. Since 2014, and especially following the expansion of financial sanctions after 2022, access to dollar-based settlement systems has been shown to carry political risk. Dollar assets, while liquid, are ultimately embedded within a U.S.-centric legal and regulatory framework. Gold, by contrast, carries no issuer risk, no counterparty exposure, and no dependence on payment networks. It settles outside the reach of sanctions and remains universally recognized across jurisdictions. For China, this distinction is critical. Gold functions as a form of balance sheet insurance, preserving value in scenarios where financial fragmentation or payment restrictions disrupt conventional reserve assets. While Beijing has not attempted to replace the dollar outright, it has been methodically reducing vulnerability to it. In an era where monetary tools are increasingly weaponized, gold offers something few financial instruments can: strategic neutrality. And as global currency relations grow more politicized, that neutrality is becoming not a luxury but a necessity. This focus on gold mining cannot be viewed in isolation. It is part of a broader resource strategy in which China is systematically securing access to multiple critical materials that underpin both financial stability and industrial power. Jin Mining Group exemplifies this approach. Alongside gold, the group has expanded aggressively into copper, lithium, and other strategic metals, materials essential for electric vehicles, power grids, and advanced manufacturing. Between 2018 and 2024, Chinese firms accounted for an estimated 30–40% of global overseas mining investment in battery and energy transition metals, reflecting a coordinated push beyond any single commodity. What distinguishes Jin's strategy is structural design. In recent years, the group has separated its international gold operations into a dedicated global platform, creating clearer boundaries between domestic assets and overseas production. This restructuring is not cosmetic. It allows Chinese mining firms to raise capital in international markets, comply with global disclosure standards, and attract non-Chinese institutional investors. At the same time, it enhances operational transparency, reducing political friction while expanding China's influence within global commodity supply chains. For Beijing, this model delivers multiple advantages. Financially, it lowers funding costs and diversifies investor bases. Strategically, it embeds Chinese firms deeper into the global resource architecture, from extraction to processing. And geopolitically, it shifts China's role from commodity buyer to supply chain architect. Gold may be the most visible asset in this strategy, but it is only one component of a much larger effort to secure long-term control over the materials that will define economic power in the decades ahead. The economic and strategic logic behind these acquisitions is compelling, but it does not come without meaningful trade-offs. From a purely financial perspective, transactions such as the acquisition of Allied Gold align closely with the current gold cycle. With gold prices now reaching $5,500 per ounce, upstream mining assets offer strong cash flow potential. Producing mines benefit directly from higher prices, while development projects become increasingly valuable as replacement supply grows scarce. In this environment, paying a modest premium for long-life gold assets can generate attractive internal rates of return, particularly when financed with relatively low-cost capital. From a geopolitical standpoint, the advantages are just as clear. Expanding mining operations across West and East Africa strengthens China's influence in regions where infrastructure financing, trade, and resource development are already closely tied to Beijing. Countries such as Mali and Ethiopia are not only rich in gold, but also strategically positioned within the broader scope of China's Belt and Road Initiative. Ownership of critical extractive assets reinforces bilateral relationships, enhances long-term leverage, and integrates Chinese companies more deeply into local economies. However, these benefits come with real risks. Mining operations in parts of Africa face persistent challenges related to political instability, security threats, regulatory changes, and community relations. Disruptions can be sudden and costly. Beyond host country risks, there is also heightened scrutiny in advanced economies. Because Allied Gold is listed in Canada, the transaction must undergo rigorous national security and foreign investment reviews. In recent years, Ottawa has tightened oversight of foreign acquisitions involving strategic resources, particularly those linked to state-backed entities. Taken together, these transactions reflect a carefully calculated balance. China is not ignoring the risks, it is accepting them in exchange for long-term strategic positioning. The result is a strategy that prioritizes durability over convenience, even when the path forward is inherently complex. Beyond gold, China has opened a second, less visible front in its resource strategy: control over electric vehicle batteries at end of life. In January 2026, new national regulations are set to take effect, requiring that EV batteries must remain attached to vehicles when they are scrapped, prohibiting informal removal, resale, or manual dismantling. At first glance, the rule appears technical. In reality, it addresses a growing strategic risk created by the rapid expansion of China's EV fleet. By the end of 2024, China had more than 20 million electric vehicles on the road, and government-linked research institutes estimate that over 1 million tons of EV batteries could reach end of life annually by 2030. Early-stage recycling systems struggled to keep pace. Informal dismantling created rising incidents of fire, chemical leakage, and workplace accidents, while large volumes of lithium, nickel, cobalt, and manganese were lost through unregulated channels. These materials are not waste, they are strategic inputs for next-generation batteries. The new rule forces end-of-life batteries into state-supervised recycling networks, allowing authorities to track, recover, and redeploy critical metals at scale. It also sharply reduces the risk of batteries leaking into black markets or being exported without oversight. In parallel, China has invested heavily in industrial recycling capacity, with leading firms reporting recovery rates above 95% for lithium and nearly 99% for key metals by 2025. As with gold, the objective is not short-term efficiency, but long-term control of supply. Batteries are no longer treated as disposable components, they are recognized as a secondary resource base, essential to China's energy security and industrial resilience in an increasingly fragmented global system. Treating end-of-life batteries as waste would miss their true strategic value. In China's policy framework, electric vehicle batteries are increasingly classified as strategic assets, not disposable components. A single EV battery contains significant quantities of lithium, nickel, cobalt, and manganese materials that sit at the core of modern energy systems and are subject to growing global supply constraints. As demand for electric vehicles accelerates, securing access to these metals has become as critical as securing oil was in the 20th century. To that end, China has moved decisively to control the entire battery life cycle. Beginning in 2025-2026, regulators have mandated the creation of a national battery traceability platform overseen by the Ministry of Industry and Information Technology. Each battery pack must carry a standardized digital identification code, allowing authorities to track it from manufacturing and vehicle installation through repair, reuse, and final recycling. This system sharply expands producer responsibility. Battery manufacturers and EV producers are now legally required to collect end-of-life batteries, disclose technical specifications, and ensure proper handover to licensed recycling firms. The scale of the opportunity explains the urgency. By 2025, China's battery recycling market had grown to an estimated $78 billion, driven by the rising volume of retired EV batteries and improvements in recovery technology. Leading recyclers report lithium recovery rates above 95% and cobalt and nickel recovery approaching 99%, levels that rival primary mining in efficiency. Centralizing this process not only reduces environmental risk, but also transforms discarded batteries into a domestic secondary resource base, less exposed to foreign supply disruptions. In strategic terms, this approach mirrors China's gold policy. Whether underground or at the end of a vehicle's life, control over material flows, not market access alone, has become the defining priority. When viewed as a whole, the pattern behind these policies becomes unmistakable. China is moving away from a model of rapid, volume-driven expansion toward one defined by long-term control and resilience. This shift has been building for years, but it has accelerated since the early 2020s, as global supply chains fractured and financial risks became more politicized. Whether the asset in question is gold buried underground or lithium embedded in an end-of-life battery, the underlying logic is the same: control the supply chain, protect financial security, and reduce external dependence. Gold acquisitions secure monetary optionality outside the dollar system. Battery regulations lock critical metals inside state-supervised industrial loops. Together, these moves reflect a deliberate effort to anchor economic power in physical resources, rather than relying solely on market access or foreign intermediaries. This is not a strategy aimed at short-term efficiency. It prioritizes durability over speed, predictability over flexibility, and ownership over exposure. In a global environment shaped by sanctions, trade fragmentation, and rising geopolitical competition, those trade-offs are increasingly rational. The most consequential aspect of this shift is its timing. These policies are being implemented before a crisis, not in response to one. History suggests that systems built for control tend to shape outcomes long after the initial decisions fade from headlines. If that pattern holds, today's quiet adjustments may exert disproportionate influence on the structure of global finance in the decade ahead. Thank you for watching the video. How do you view this transition? Share your perspective in the comments below.